G'day everyone, Lindsay here, and welcome to our webinar on US property investment. I'm excited today to share with you our strategy on successful investing in US property and how you can create life-changing passive income. This is great information I'm going to share with you, and I know because you're here, you're serious. So settle back, grab yourself a glass of your favorite red or coffee or whatever you like. Switch your phones to silent, unless of course you're listening to me on your phone, and let's get started. All right, here we go. Now let's head down to the presentation. All right, hopefully everyone can hear me and you can see the presentation there now. A couple of quick things, just wanted to give a quick disclaimer, start by reminding everyone that we are not financial advisors or accountants. So I do strongly recommend before you make any decisions on your investments that you speak to them. Make sure they know your financial positions, your tax implications, both here and in the US, and anything that you might come across by making these investments. I keep my financial advisor and accountant real close. Also, make sure you stay through till the end. We have a fantastic offer coming up that you need to be on for. So to take advantage of that and watch out for it. All right, let's move on. Who are we? So Star Dynamic, we're an Aussie-based company in the southern suburbs of Melbourne. We have no affiliations with any US property developers or real estate agents or similar. We're not trying to sell you US property. I mean, we do own property in the US, but that's my property. I'm not selling you that. We are more like a buyer's advocate or sourcing specialist. So what we focus primarily on is helping Aussies source good quality cash flow properties in US. We look at wholesale properties that are below market value so you can get immediate equity and with really good cash flow. It makes it a really great deal. We started our property investment journey about 12 years ago. In that time, we've looked at a number of different investment opportunities, different regions, and many, many different strategies. Over these years, we've purchased many different styles of properties and in a number of different regions of Australia, capital cities like Melbourne, Canberra, Brisbane, even rural areas, Toowoomba, regional New South Wales, quite a varied portfolio really in that time. Types of properties we've had, student accommodation, land, subdivisions, developments, townhouses, rentals, renovations. We've done a lot here in the Australian market. Around about 3 years ago, we stumbled across the US market, and that was something I was quite interested in when I heard about it. I didn't actually know at the time that Australians could actually purchase property in the US. It wasn't something I was aware of, and I think that's where a lot of people don't realise. So we looked into it at length. We've been over to the US quite a number of times now in the past few years and completed some intensive learning over there, a lot of property seminars, home shows, etc. We've now developed quite a network of highly experienced people and very successful in the industry. It's really exciting. We've had family and friends who we're doing ask if they could get properties for us, for them. So we started sourcing some properties for some colleagues, friends of theirs, some referrals. And sooner or later, we looked at it and thought maybe there is actually a bit of a market here. Most Aussies who are interested in investing don't realise that the US market is actually an option. So that's when we developed Star Dynamic Property Investments. A star was born. We decided to do it for ourselves, and now we have a well-proven strategy, so why not help others do exactly the same thing? That's where we began in US property investment, creating high passive cash flow on low cost property with high return. That sounds good, right? Okay, today I want to share with you some insightful information. I want to show you how to invest in great positive cash flow properties to generate passive income. An important point here is we can do this for less than the deposit of a property here in Australia, particularly now with the new banking regulations. We'll look at the reasons that you want to invest. What is it you're actually trying to achieve from property? Have a bit of a think about this. This is a real key point. I won't spend too much time on it now, but it's something I want to make sure that you have clear in your mind that what you want to achieve out of property. Look, property is great. I love property. It's a real passion of mine, but it's something at the end of the day, any individual property is just a house. It's just bricks and mortar. It's just weatherboards. That's all it is. What you really know is what is it you want to achieve. The property is a vehicle that can get you to what you need. The cash flow you can get is great, but again, what is that going to give you? Allow you to give up work, spend more time with the family, holidays. That's the sort of thing we want to help you to discover. This is the driving force that keeps you focused when things don't go right. I want to debunk a few falsehoods the media feed us. If you're reading the media at the moment, there's a lot of information, particularly about our Australian market. What is the right way to invest? What is the wrong way to invest? The housing boom, bubble burst, all this sort of thing. So I want to go through some of that. I also want to show you some options you may not have known were available to Australians here and in the US market. Okay, why? Why is it that you want a passive income? Why is it you're looking at doing something outside of what you're doing now, your job? Why do you want to branch out? Maybe you want to get some time back. Maybe you're working long hours. Do you want to give up the job altogether? Go on a holiday, buy a boat or a car, shop? Do any of these reasons resonate with you? What I want you to think about this and crystallize, because like anything else, what property investing is a tool or a vehicle that's going to get you somewhere. And I want you to know where that somewhere is. So I've got a question for you. How much do you need to generate to remove financial stress and pressures? Now, just throw it in the chat box now, just a rough estimate. I don't have to be exact, just an idea of how much money per month you would like to have coming in passively just to cover your bills, basically the cost of living. Covering all this will give you the security to know that when you wake up in the morning, you've got your bills covered and anything else you do is profit or spending for you. So is that 2,000 a month? Is it 5,000 a month? That's the question I'm asking. Let's say 5,000 is a good number. A lot of people are saying 5,000. So that would cover most of your bills for each month. So next question. How much money would it take for you to generate per month to really change your life? Now think on that for a second. The first one will give you financial security. The 5,000, say, as we said before, you now know that all your bills are paid for, but to really change your life, what are you looking for? Do you need 10,000 a month? Would 10,000 per month cover all your bills, give you that financial security and possibly a holiday or two, a new car, enable you to move to a nicer, bigger, better home? Would that be enough for you to say, I don't need to work my job anymore? That's 120,000 a year. If you're after the financial security, then the 5,000 mark per month is probably what you're looking at developing. And we can show you how to do that and develop that sort of income. If you really want to change your life, then what you want to be saying is that 10,000 or 12,000 or 15,000 a month, I want that money coming in every month, whether I get up in the morning or not. That's really something you have to be able to crystallize. So let's work on perspective now. How much do you think you need to invest to earn that sort of money? So let's start with the financial security. 5,000 a month, that's 60,000 a year. Based on an average return on investment here in Australia, how much money would you need to invest to be able to earn 60,000 a year? Now, if we say an average of, say, 5% return on investment, I think that's probably generous here, but if we include capital growth in the properties in Australia, that's probably just over $1 million you'd have to invest. If your standard return at the moment might be 3 or 4%, which is probably closer, you're getting bank bonds or similar to that, then you're looking at $1.2, $1.5 million. Now, if you're lucky enough to have property in Metro Sydney or Melbourne, some good growth corridors, you might get 6 or 7% if you're including the capital growth. Not certain that's going to continue every year. I think Sydney's seeing a bit of a flat spot at the moment, for instance, but you'd still need $800,000-$900,000 worth of property to get that sort of return. So then the change your life figure, that 10,000 a month, which is 120,000 a year, or 150,000 a year, over and above what you're earning now, how much would you need to invest to make that? Now, I mean, we're talking probably upwards of $5 million, right? Now, these figures are really hard to fathom, aren't they? Just let me think for a second. I don't want you to focus on the amount needed just yet, just more about what you want. Would you be interested in learning more if I suggested there are ways you can earn that return, that 50, 60,000 a year, or that 120, 150,000 a year for less than a quarter of the investment that you think, under 25% of those required funds? Sounds awesome, right? All right, let's move on. Now, let's imagine how we can get you to this little piggy bank here. Let's say, for example, that you purchase your first property, one house, and it's worth 10,000 a year to you in cash return after all your expenses are paid, putting into your bank account 10,000 a year. Some houses will do better than that. Some might not quite do that, but let's just work on this scenario for this case. Now, how's that for a return on investment? That's pretty good dollars, right? So a 3-year plan, looking back at that cost of living you're trying to cover your bills for, in the next 3 years, if you were able to buy 5 investment properties and each of those properties was earning you 10,000 cash flow per year, like that piggy bank was showing last there, that's 50,000 per year cash flow coming in for you. How does that sound? Now that's going to give you some financial security. You'll be able to pay your mortgage, you'll be able to pay your car, pay your internet bills, etc., etc. You can start to see that lifestyle that you like, can't you? So your question I'm sure you're thinking now is, well, how do I buy 5 rentals? Well, let me show you that shortly. But let me just say this. It's not as hard or as expensive as you may think. This is something that's not difficult to achieve, and it's something we can really show you how in the next 3 years you can really do this. Do you want to go that next step though? Do you want to really look at something that's going to change your life? Well, that's why you're here, right? Let's have a look at a 5-year plan then, where you're looking at getting 10 investment properties over the next 5 years at a 10,000 per investment property, passive income. That's going to give you around 100,000 per year income. Now that's good money, and that could really replace most people's wages. Again, don't worry about how you can do this. I'll show you that shortly. But these are exciting dollars, right? Your 3-year plan can really give you some financial security and can take the weight off your shoulders and give you a little bit of the notice to know those bills are paid and that you're able to pay down some debt. Or alternatively, the 5-year plan is something you can really start to look at giving you some freedom financially to make some decisions. Maybe within that 5-year plan, those 10 properties are going to be able to make you cut back to part-time work, or maybe you can give up work altogether. Maybe your partner can give up work and you can keep doing what you're doing if you enjoy it. Wouldn't you love though to be able to make that decision? That's what financial freedom is all about, the freedom to make these decisions. This is real. I love that we've been able to successfully help many Aussies on this path and a proven strategy that works. So I want to help you too. Sounds good, right? Okay, I'll quickly go through the property market here in Australia. I won't go into this in too much detail, but it's a good comparison. Most people would know it's a difficult market to get into right now. You need to have high deposits, particularly with this new banking regulations and the issues that APRA are doing. You could likely need around a minimum of a 20% deposit. Actually, some investment loans are now asking for 30% deposit. Median house price in Melbourne alone is over $850,000 and climbing. And I was reading a few months ago in one of the magazines, the median house price in Sydney has just pipped $1 million. Now that's scary figures, really. If you're already in the market, then maybe you're earning some good capital growth on your properties, which can be great. And you can take that capital growth and extend again. But it might be difficult because, again, depending on how much that property is earning, or particularly how much you're earning, and it may not even be a positive return for you. So the banks very quickly start to dry up and stop borrowing. So you might be able to get a second, but you may not be able to get a third or a fourth or a fifth. And as we saw in those earlier slides, that's really where the money and the wealth can come in. We know also that the returns in Australia can be very difficult, very low. And this pegs back to the previous slide with such a high cost of properties. The returns you're going to get can't keep up. So the rental returns don't match the cost of the property. A renter can't afford to pay you 5-10% of what you paid for the house. So you're just not going to be able to get that. If you can earn 2 or 3% as a rental, you've done pretty well here. The Australian market's still in quite a boom state. I know some of the media reports at the moment are saying that Sydney's flattening out, and there's even some talk about bubble bursting and all that sort of stuff. And that's just sensationalising in the headlines. But things are starting to flatten a little bit. But in general, still the market is still in a real boom. There's still a very expensive, very hot market. Still some good growth in a lot of areas. East Coast particularly, very hot, very expensive. So Sydney, Melbourne, Brisbane's starting to get there, and the West will start to pick up as well. Actually, I was reading there's some big movement in Hobart, actually, down in Tassie is starting to get up. So again, very hot, very expensive. Now, because of this, negatively geared investments are what property advisors or investment advisors are even suggesting is a good idea. Now, in certain circumstances, if you're at certain wage levels, you've got certain tax criteria, then there can be some benefit for negatively gearing investments. But really, on a whole, I'm not a fan of negative gearing at all. I don't believe a property is something that actually should be taking money out of your pocket each month. The definition to me of an investment is something that returns you an income, something that takes money from you each period, whether it be weekly or monthly. I used to call an expense. Now, I also believe that to pay $1 to save 30 cents as tax is still a crazy theory. One of those falsehoods that the media feed us is this is the way we should be doing it. I have another term for negatively gearing, and I call it the buy and hope strategy. I mean, essentially what you're doing is buying a property that's costing you money each week in the hope that the markets are going to rise and you'll get capital appreciation. And maybe it will. And in a lot of areas in Australia, that has happened. But it doesn't always do that. As an example, if you bought a property, let's say you bought a 3-bedroom townhouse in Glebe in Sydney, maybe 10 years ago, you'd be absolutely laughing. That property would be worth more than 3 times what you paid for it now. And that's incredible appreciation at that time, far exceed anything that you would have had to pay out as a negative return. So at the end, you have a positive return, and that's great. Now, if you had bought that property in Moranbah in Queensland when the mines were at their highest, and then all of a sudden now the mines have closed, people were literally paying $800,000 or $900,000 for 3-bedroom homes in these towns that they now can't sell for $200,000. No, let's get closer to home. You were to buy a property here in Docklands in Melbourne. There's around about a 60% vacancy rate on a lot of these high-rise buildings, and these properties have lost over 15% off the price they were purchased for in the last 2 years. Now, once again, if these were negatively geared investments and costing you money every month, and the property's now lost also 15% off what you paid for it straight off the top, then that can really put you into some financial stress. Okay, so why US? What's the difference? Well, the US is a politically stable country. Now, one of the things I do get asked a lot about is how Donald Trump is affecting their market, and that there's nothing stable about him, some would argue. But at the end of the day, he's a businessman and he's not going to do anything that's going to affect his back pocket. They welcome foreign investors. There's no boundaries on foreign investment, and there's no criteria allowing us only to purchase X number of properties or only invest X number of dollars. If we have the money, we're welcome in the country, and that's what it boils down to. New growth. One of the advantages the US market has over the Australian market is we are really riding high on a wave here, whereas in the US, particularly the GFC hit them so hard in 2007 that it's taken them nearly 10 years to get back up. So it's only been about 2013 or thereabouts that the market has started to build up again. So there's a real advantage to us because we can get in now while it's really starting to rebuild. It's only just starting to find their feet before that growth kicks in and we can ride that wave again. High quality properties are affordable and very positive cash flow. You can't ask for more than that, right? There are some high quality properties over there. And again, I go back to the GFC because of the crash. These properties are now very affordable and very cash flow positive due to a very strong rental market. The USA is also now enjoying really good economic growth. They are really starting to pick up. Wages are increasing. The unemployment rate is improving. Their dollar is starting to strengthen. Another good reason why it's time for us to invest in their market. And really, the US dollar is relatively weak compared to the Australian dollar, or actually, what I should say is the Australian dollar is very strong still. Now, that won't stay the same all the time. The US dollar, as their market continues to pick up, is going to strengthen, and that'll give us a second string to our bow that we can profit from the exchange rate of the US dollar. Now, we don't necessarily bank that into our deals because, again, a little bit like that buy and hope strategy, you don't know what the dollar is going to do. But if it does assist us and increase our profits, let's take it. Right, the US itself is a melting pot of very, very different markets. Very similar to Australia, there's many different market forces affecting the US, particularly with the size of their market. But they're very stable areas, very strong capital growth areas. If you were to look at the east or the west coast of the US, you'd be looking at markets very similar to what you see here in Australia. If you look at New York or Boston or Seattle, San Francisco, Los Angeles, now these prices you're going to be looking from anywhere from 600,000 US dollars per property upward. Same as if you were looking for a unit in Sydney or Melbourne. Funny story, actually, I had a client come to me about 6 months ago, a doctor, she was in Sydney, wanted to buy a 2-bedroom unit in San Francisco, wanted to send her son to Stanford University. She had $500,000 to spend. Now, we looked around for about 3 months, and the closest we could get was a 2-bedroom unit so run down you couldn't live in it, and they wanted 760,000 US dollars for it. Just in crazy, crazy numbers. There is a huge market or a huge area which they call the Midwest. Now, some of these states are not necessarily in the Midwest, but there's about 38 states that we can look at, and this market is really untapped. There's highly populated areas. We're still talking about 150 to 180 million people living in all these states within this region, and these areas are where we really do look at. The GFC, as we hinted on before, the global financial crisis had made a real impact on the US economy. That's where it started. They're only really now coming out of it. It's been a number of years since it hit them, but it's given us the advantage that their market fell so sharply that there's a long way for it to come. And this gives us the opportunity to get in while it's still rebuilding. So many homes went into foreclosure over that period of time. Over 24 million homes went into foreclosure during the GFC. Now, that's more than one home per Australian. Not only that, there were 7 banks failed. Now, I think 3 or 4 of these banks were bought out by the big banks, but these banks don't even know what properties they own at the time. They're still in the vicinity of 11 to 12 million properties in foreclosure right at the moment. Now, some of these properties haven't had people in them for 10 years. Some of the properties still have the original owners in them, and they haven't had to pay their mortgage for 10 years because they've been foreclosed on, but the bank still hasn't got around to claiming back the property. So there's some huge benefits and opportunities here for us. The homeowners really got into trouble. They really went underwater, meaning that is that they owed more on their property than the property was worth, not physically underwater. And some of them just had to walk away. This was something that really hit them hard. But now, of course, the markets are starting to really rebound and we're starting to see growth again in these markets. These properties that were worth $300,000 all of a sudden after the GFC are now worth 40 are getting back to now nearly double that and starting to grow and give us some really opportunity. But we can now still buy these properties for 60, 70,000, not the 300,000 they were, and we can still make the great rental income from them. The banks are still working through these foreclosures. Now, the foreclosed homes are something else we can pick up. We often do a bit of renovation, clean these up, and then they're great properties again for us. The rental demand is very, very strong in the US. It's one of the other things that actually was caused by the GFC, particularly the last 10 or 15 years, maybe just a little bit before that. The US is very much more capitalist society than Australia, for instance. In Australia, if you don't have a job, you can still get Medicare, financial assistance, Centrelink, rent assistance, all that sort of thing. The US doesn't have the same sort of process. If you don't have a job and you don't have healthcare, then you can't go to doctors. Hospitals will turn you away. If you don't have a job, there's no easy way for you to get welfare. What happens is people are then very keen to travel if they have to for work. If they have to uproot and move to other cities to get a good job, they'll do it. And they'll rent because they don't necessarily want to live there forever, or they don't know where their next move is going to have to take them. On the other hand, the other thing they're very focused on is schools, because again, you need to get a good school. You'll move because the good school allows their kids to get a good job. And it's right back to that capitalist society's wheel again. So as I said before, the markets are really starting to come back. Rental demands are strong and it gives us the opportunity to get in now. Okay, whereabouts should you invest in the US? Well, again, there's many areas and many regions. If you take this map here, now look, I haven't highlighted these individual states for any reason. They're just part of the picture. But if you take a line down the Appalachian Mountains, which is on the east coast here, and if you take a line down the Rocky Mountains on the west coast, anywhere inside there is 30 plus states, and there's some really good regions. Michigan, Ohio, Illinois, Tennessee, Florida, Texas, Nevada, many, many more. These are some great areas. Actually, another interesting story for you. Nevada, we were in Las Vegas a couple of years ago at a massive big investor expo, a bit like our home show, but on steroids, really. Lots and lots of companies trying to sell you houses, insurance advisors, financial advisors, all that sort of stuff. We were doing some seminars there, which was great. We were sitting in a seminar. We just listened to the first one. The next one coming up, they introduced a couple. They said they do this show, and we found out afterwards they host a show called Flipping Vegas. Now, I don't know if you guys have heard of this show. They ran through the audience up onto the stage. The crowd is going wild, and we're just sitting there looking at each other going, wow, this is crazy. Who are these people? But the crowd loved them, and their story was really, really interesting. Now, it was a great story talking about how they work their TV show and the properties that they buy, they do them up, make them look really good on television and sell them and what the return they would have got for the sale. But they were actually saying they don't sell any of these properties. They keep every single one of them. They are actually making too much money for them to sell. They have a portfolio of over 300 properties, all in Nevada alone. And it just blew my mind. it is just amazing that this is the sort of thing you don't realize, but there are lots of people in the US doing exactly this at the moment. They know where the markets are rebounding and it's a real opportunity. So why don't we get in as well? All right. Oh, let me go back a sec. Sorry. All right. So what criteria do we look for when you're searching for these areas? So what is it about an area that's going to make it good? Well, the first thing you want to do is look for city infrastructure spending. Any place where the city or the council, as we would call it here in Australia, are spending money means that there's growth. And where there's growth, it flows into the property market as well. And that's one thing that's really important, and it's on the top of the list deliberately. The second one, though, is employment, as we were speaking before. You want to look for areas that have solid employment opportunities because, again, that's where the people are going to move to. People will travel. They'll travel across states if they have to get good employment. Schools or universities are important, again, as we were saying earlier. Income is so critical in a capitalist society. People will travel to put their kids into good schools and through good universities so they can get a good job and get good employment. Now, crime rate is another you probably hear of that you want to keep a look at. And of course, you want to make sure you're not in high crime areas because that's not where people will want to live. And then you'll struggle to get good tenants, and then your vacancy rates will struggle. So at the end of the day, though, vacancy rates is one thing you want to keep an eye on, and crime rate you want to keep an eye on. But generally, these two are really a symptom of missing the top three. So if you get in and find that the area doesn't have good schools, doesn't have good universities, doesn't have good employment, then generally what will happen is the crime rate is higher, and then of course the vacancy rates are high. So they really go hand in hand. All right, let's move on. Very quick recap, US markets are rebounding after GFC, many homes available, affordable at low cost, rental rates based on the demand, not directly related to the property costs. Now, the properties are also available for purchase, this is a good point, for less than the cost of the deposit here in Australia. It's just nuts. And that's another huge point, and we'll harp on that in a minute. I'm sure it's something that's going to stand out to you. Lower capital growth, though, in the market's very different from here in Australia. You're not going to get that high growth per year or capital growth, but much higher rental returns year on year. You can also get tax credits for anything you bring back here in Australia for the tax you paid in the US, but it would be a great opportunity for you to have a chat to your accountant about your tax issues there. All right, the Australian market, we've got very strong growth in all capital cities, high growth in the last few years, high entry costs though, and much harder investment regulations at the moment with a minimum of 20 to 30% deposits. Some banks are even knocking back investment loans, putting a cap on how many they can do per month. It's really getting difficult. Residential returns offered here have hit a ceiling. You can no longer get that they don't relate directly to the property cost. So even though the property may cost you $1.5 million now, it doesn't mean you're going to get $100,000 a year as a rental return. It just doesn't work that way. So the most popular strategy we've here since the government introduced in 1997-98 is negative gearing. This method allows investors to save tax and claim losses on properties against your primary income. Now, I'm not saying the law is bad. I just think it's a strategy that's used way too much. And I know that the current treasurer, if he could, would kill this off, but I don't think he's going to be able to. But there's still talk about that. All right, so what type of properties do you need to look for? So let's say you worked out, okay, Lindsay, I know the area I want to invest in. I've done my homework. The area looks good. There's good infrastructure spend, et cetera, et cetera. What sort of property do I need? Well, the first and most popular would be what they call a single family residence. Now, this is what we normally see here in Australia. One house, one tenant or family, easy to find, easy to manage, good returns, and there's lots of them. Second option, now this is something we don't get a lot of here in Australia, we call multifamily residence. Now, in the US, these are actually quite popular. They look like a single family residence, they're essentially a house, but they've broken it down to have maybe 2 families or 3 families in the house. The closest you'd see here might be a home with a granny flat or something at the back where you rent the granny flat out separately from the front. Now, multifamily homes in the US may have like an upstairs and a downstairs where you have 2 bedrooms, bathroom, kitchen upstairs, 2 bedrooms, bathroom, kitchen downstairs. They might share a basement or something like that, which might be the laundry. There's actually quite popular in the US. There is a lot of them around. Now, the returns you get on those properties are a lot higher because you have one property, but 2 sets of tenants. So whereas with the single family residence before, let's say you get $700 or $800 a month for that property. In this case, you might get $600 per month for the top and $600 per month for the bottom, which is $1,200 as opposed to the $800 for the single family. Slightly more complex though to manage because of course you're dealing with 2 tenants on one property. Now there's less properties available. They're not as easy to find, but they're really worth looking for. Okay, unit blocks are another one. Now these are a much higher investment again, much higher returns again, but also much more complex. You could be looking at a block of 5 or 8 units, but the complexity on these is different. Sometimes the unit blocks, particularly where the landlord has to pay water rates or other utilities, and you've got to look out for that. But on the other hand, the returns are great. I saw one come through only a few months ago, 28 units. The return was 32% return on investment. Absolutely incredible. I think it went for $480,000 or $460,000 or something like that. If they can find them, they're great. If you don't mind the complexity, they're fantastic returns. Now, the last one is what we call rehabs or renovations, or if you watch those Flipping Vegas shows, they call them fix and flips. Say that quick. Very popular in the US, very particular. As we were saying about these properties, you can get these foreclosed properties and do them up, make a real difference. Buying these properties very cheap because they need work and there is so many available. Now, there can be good profits on this, but it is considerably more work again. The management on this, you've got to manage contractors, inspectors, etc., but can be very good returns. These are what we would call chunk deals. This is not passive income. This is active income. So let's say you buy the property for $30,000, you spend 20 on it, so you're up for 50 for the deal, but you can sell it for 70. That'll give you a $20,000 cash return. Now you grab your $20,000 cash and you go and do it again. Now, they can be a strategy you can use for a cash flowing rental. So the previous property, let's say we buy it for 30, we do it up and we're in it for 50, but now you can put a tenant in it and your return on the investment might be as high as 15 to 16, 18% because the property's worth 70, but you only paid 50 for it, including your rehab. So there's another real benefit there, but this is a very active strategy. All right, how to assess property values. So you say, Lindsay, okay, I found some good properties. I've got a good area. How do I know that this is a good deal? How do I know that this one is worthwhile? Well, the first thing you want to do is you want to look at and try and determine what we call comparables. So you want to look at comparable properties in the same area, similar size, similar number of bathrooms, number of bedrooms. If does it have a basement? Does it have a garage? All this sort of thing to make it comparable. And is it in the same condition? Comparables are probably one of the best ways, provided you can, of course, assess the condition of the comparables to determine what the market is like in the area and what the property you're looking for, whether it's worth buying. Online estimates are another good one. Now, these are websites you can go to give you some estimates and tell you what the property value is worth. I don't know if you think it's necessarily worth trusting some of these, but they can be very good. The problem with online estimates is they work solely on historical data. They only look at what the property of similar size has sold for in the area. Now, if a property particularly needed a lot of work and only sold for 20,000, then what happens is it drags the online estimate of other properties in the area down. If you get a property that was renovated to the best level and sold for 150, then it drags all the others up, even though the other properties can be in very bad case of disrepair. So you've just got to be very careful with your online estimates. Here's a couple of the websites that we can use. I do recommend you have a look at these. Trulia and Zillow are pretty good, just as they're spelt there, Zillow.com and Trulia.com. These ones are essentially the same as our Australian version of, say, domain.com.au or realestate.com.au. Properties for sale, properties for rent, you can have a look. Very good checking out comparables as well. You can look at the properties that are for sale in the area, and you can also look at properties that have sold recently in the area. Rent-A-Meter is a property rental website. I haven't spelled that wrong. It's exactly how they spell it in the US. Rent-A-Meter is giving you an idea of, let's say you have a property, what that property might rent for. So again, it's using comparable data saying, well, all properties in this area of that similar size are renting for this much. Now, lastly, what we look at is minimum return targets. So what we do is we ensure that the property is for sale for less than market value. So we use comparable value or what we could call after repair value, market value, and then making sure that the purchase price is less than that, giving some instant equity. Now, what this does is this also allows you to sell the property and get your money back if you need to at any stage without loss. Sometimes it allows us to sell it quickly as well. The other rental return or return on the property is what you call ROI, return on investment, is your rental, and that needs to be at least 10% or greater after costs. If so, then it's worth looking at. And that's the determination we use. Only properties that meet both these criteria would we consider to be a deal. All right, I've got a couple of little handy calculators we use, and I just wanted to go through these very quickly for you. This is what we call the maximum allowable offer calculator. This allows us to look at properties that need work, and we can put in what the market value of that property is by doing some comparable research we were talking about before. We do some estimates on the repair costs based on the size and how much repair is needed. And we have, let's say we have some holding costs and so forth. So we put that in there, profit target. We want a minimum of 20%. 20% on any of the flips is a minimum because there's a lot of work to do. So then you would turn around and say, okay, for this property, if the ARV, the after repair value or market value of the property is 75,000, but it's going to be 15,000 to get it up to that standard with all the other holding costs, minimum of 20% to profit. Therefore, our maximum allowable offer we can pay on this property is $38,940. So that gives you a bit of an indication on where to start. So straight away we say, right, if the property's on the market for 60,000, we know it's too expensive. 60, but you've got to spend 15 on it to get it up. So that's not enough. Now, if the property was on the market for 45, then maybe you could look into it and maybe offer them 35, something like that. See what happens. Now, here's another one. This is a really good one, a quick one that we use all the time. This is our rental return calculator. We put in the price we pay for the property. So let's say the property we bought for 43,000. The purchase price, title agency fees, finance, rehab costs, if any, all that example, you throw all these in. Then you say the rental return on this property is $850 a month, so your yearly rental is $10,200. You allow for property management costs, maintenance costs, etc., etc. Your rental return or cap rate on this property, taking all those into account, as you can see there. So if you bought this for $43,000, then your rental return on that property would be 12.6% after costs. So that would be a good property to look at, provided, of course, like we said before, the purchase price of $43,000 is less than or equal to the market value. Then it makes it a really good option. If you want to copy these calculators, by the way, shoot me a quick email after the webinar. I can send them off to you. Can be very handy when assessing properties. All right, let's just recap, go back to this 3-year plan. So we want to look at getting on that $50,000 per year income. We can look at getting 5 investment properties with $10,000 per property cash flow, that $50,000 income per year passive. You particularly maybe like the 5-year plan. Let's say you want that $100,000. Well, that's fine. We're looking at a 5-year plan over the next 5 years and how you can get 10 investment properties. My next question for you is to ask yourself, is the 3-year plan, how much do you think you'd need to invest to buy 5 properties to give you that $50,000 per year? Depending on your location, or even if you're looking at regional areas, you'll be looking at upward of $2 million maybe, right? 350 to 500,000 per property, maybe. That would be $2.5 million to get all those properties. Then if you're wanting to put 20% up for that, let's say you have enough wages or income to support the borrowings, you're still up for $500,000 for the deposit on those. Now, what if we said that we can show you how in the US you can get these 5 properties for less than $300,000 outright? Less than the deposit you would need to purchase those same 5 properties here in Australia. Great, yeah? Now, one step further, look at the 5-year plan. Over the next 5 years, those 10 properties, instead of costing you something in the vicinity of $5 million, meaning that you're going to need $1 million worth of cash or equity just to be able to put up to borrow the rest, and that's if you can service that. Less than $600,000 can get you those 10 properties. And you don't even have to have that $600,000 right now. It's a 5-year plan. That's the best part. You can use the profit from the first few properties to help you buy the others. Impressive, right? On the other hand, let's just say, well, that's great, Lindsay, but I don't have 250,000 plus to invest right now. Can we still do it? Do we still have options? Well, my answer is actually yes, you do. And this is where you can we can sit down and develop an individual strategy for you and work through a plan where you can develop a cash generation strategy. So let's say, okay, you've got 50,000. Do you have 50,000? You say, yeah, I've got 50,000 from an investment property, or maybe you've got some equity or something along those lines. So what we do is this. We take the 50,000, buy a property, buy yourself a flip. Let's say you pay 35,000 for it. Needs work, you spend $15,000 on it. So there's your 50,000. You sell that property for 65, and you get your return from the property, which is $15,000 return. That's almost a 30% return on your investment. Really worthwhile in its own right. But now you've just made yourself $15,000 worth of profit. You've still got your 50 capital. So you do that in about 2 to 3 months, start to finish, cosmetic repairs, that sort of thing. So what do we do? We'll do another one. Take that 50, you go again, you buy another property, similar numbers, sell it for 65, get your 15,000 out. So now you got your 50,000 again, but now you got $30,000 profit from these 2 flips. So before the year is out, let's say you manage another. Now you've done 3 flips in the US, you've been able to buy these properties, do them up and sell them. making 15,000 thereabouts per property you've flipped. So you've got $45,000 worth of profit and you've still got your $50,000 capital. So here's where you now go and buy yourself a rental. Take your 45, go purchase your rental. It's going to give you about a $10,000 a year income, about 20%, 15% on your investment. You've still got your $50,000 capital. So then off you go and you repeat year two and away you go. So this is the sort of cash generation strategy we can help people do. Now, by the way, so year two, you've now got yourself two rental properties, plus those two properties have earned $10,000 each. So you've got another $20,000. So at the end of year three, you can go and buy yourself your third property, and you've probably also got enough in $30,000 or $40,000 to get a fourth. So this is essentially how you can do it without necessarily having all the cash up front. Note, this is a very active strategy that requires a lot of hands-on, a lot of dealing with contractors, but very profitable, yeah? All right, next question. What can we do for you? So look, in short, we can do as much or as little as you need. If you're finding all this information exciting, albeit a little daunting, we can act as your feet on the ground and do everything for you. If you like the idea of wanting to learn more, soon we're going to have an upcoming members portal where you can get in and do training on all these areas we just spoke about and do the process yourself. We run live events in all capital cities, offering people a chance to meet up with other investors and like-minded individuals, talk strategies and options. We also often have guest speakers looking at particular areas in US investing. Head to our website for more details on all this. For our full service, firstly, we will source the property for you. We'll make sure it's the right property. We'll sit down and go through and develop a strategy. So then we know what properties you're looking for and we can find and source the correct property for you. We create company structures to help protect your assets over there. As you know, the US is one of the most highly litigated societies in the world, but I think Australia isn't too far behind, but still. So we create all these company assets to make company structures to help protect all those assets. We help close on the property, make sure that all the closing costs and everything are done and paid and covered. You don't have any issues with closing and the actual purchase of the property. Closing is the same as settlement here in Australia. We connect with the best property managers in the area, and for the tenants and the maintenance, the property managers are critical. These guys are your front line for you. You want to make sure these people are doing the best job they can, and we make sure that we only use the best. We ensure that the property is tenanted, make sure that those tenants are in place, make sure they're screened properly so you've got good tenants, less hassles. Set up insurances for the property as needed, making sure that you can get the insurance so in case anything goes wrong. You can even get landlord insurance if you want to cover your rental loss. It's a little more expensive, but it is available. Help set up trust accounts, escrow accounts they call in the US, for the funds so that you can have it deposited in. We can also assist with getting you a bank account set up. That's something that you have to do yourself, but we can go through and give you the process on how it's done. You can then pay contractors, repairs and maintenance for your property managers out of the escrow accounts and etc. Can help provide some taxation account contacts. As mentioned at the start, we're not tax agents nor accountants. Happy to provide you some contacts if you need to. We've got contacts here in Australia, but we also do have some contacts in the US, and that might be able to give you some clarification that you need. Can be really handy. We can help with the foreign exchange service through reputable companies here in Australia to help reduce and minimise these charges. Now, if you're moving a large amount of money over there, we use a couple of companies that don't have the fees and the charges that the big banks do. The big banks can be very expensive. The companies we have very good rates and without any fees can really save you a lot of money. We perform solid due diligence on all these properties and supply it to you prior to the purchase, so you don't get caught in any hidden traps. We make sure we do good quality, fully documented property inspection reports. We perform full title searches, including comparable values on the title searches, so you know what the property's worth and the title's clear. We can get video walkthroughs, photos, etc. of the property, so no surprises, nothing untoward you didn't realise right up the front. We give you full visibility of all of that. And as we said, we can help pick the best strategy for you. You might say, right, I've got $200,000 or $300,000 in the self-managed super fund, or you may have a super fund you can make self-managed. Then we can take that money and go and buy 3 or 4 or 5 investment properties. Your super fund will start earning $50,000 a year on year for you, and you can just sit and relax. You can sit back, and then when you're ready, the super fund's there for you. After a few years, that 5 properties can become 6 or 7 in time. You can even have those 10. When you retire, you might then straight away have $100,000 per year income sitting there ready for you without even selling any of the properties. Also, within a super fund, extremely low tax. If you don't have that, maybe you've got the 50,000, we can help you with some flips, the cash generation strategy or something along those lines, or at least get you started on a couple of properties. Okay, let's have a look at some examples. Here's some examples, real properties that we've had for some of our clients. This one here is in North G Street in Pensacola, Florida. This was a 2 bedroom, 1 bathroom, just a small house, 1,150 square foot. Price of the property was 34,000. Now, this was actually the property that was in that original rental calculator. Um, it was rented for about 800 a month. It was actually tenanted on the time that it was bought. It had long-term tenants in place. The rental return on this property after all expenses is 14%. This is a very good deal, just a small place, but and low dollars. But you can see that the maintenance costs and everything are very low. Great long-term tenants means there was no vacancy rate. Didn't have to change tenants. So in fact, the cap rate really was probably a little higher than 14%. But on paper, you have to allow for all events. You can't tell if the hot water service isn't going to break or whether the tenant was actually thinking of leaving or not. So you still calculate this in. All right, here's another one. This was in Wisconsin Road in Detroit in Michigan. It's a 3 bedroom, 1 bathroom, 1,500 square foot property. This was 34 and a half. The rent on this was 750. So this cap rate was just a touch over 15%. Slightly higher than the Pensacola one, slightly larger property, very sought after brick property like this. Good solid basement, really popular in the US. This was vacant for 2 weeks, so it was really easy to get a tenant. Okay, this one's in Florida again. This was in Milton. 3 bedroom, 2 bathroom, good size house, 1,700 square foot. This was actually a flip. So this one the client purchased for $98,000. They had to spend $12,000 on it basically to get it up. Now they had to redo the kitchen, but then there was just some flooring, sanding, timber floors, mainly painting, cosmetic stuff. The market value for this property when it's completed was $145,000. So that's a 32% return. Now, admittedly, in this particular case, I think they rented it out rather than sold it, but still, that was a really good return for them. All right, here's another one in Detroit. This was another flip, very good one. This is a 3 bedroom, 1 bathroom, small property, 730 square foot. The price was 19 and a half. It took 13,000 to bring it back up to standard. Needed quite a bit of work on the property, but the after repair value on this one was 45,000. So this was a 38% return on investment. These guys who did this have done 4 other properties since then. All right. So hopefully you now got a better understanding of your options in thinking broader. So what's the next step?